Francisco, I think we have your audio now. Talk to me about crude prices from here.
Yeah, absolutely. So, look, a couple of weeks ago, we put a note out entitled 80 is the new 60 for oil. And what that means is that OPEC is going to be proactively reducing supply as prices get into the 80s range. We've also seen the U.S. Government talk about potentially refilling the SPR as prices come below $80 a barrel. So I think there is a lot of support for prices in this range. And we think from here on, we're likely to see upside. Obviously, 2 million barrels a day is above expectations. Now, I think one of the big questions is, are we really going to get a 2 million barrel a day real cut, or is it going to be a 2 million barrel a day nominal cut that is essentially readjusted by the fact that OPEC itself is producing by 3 million barrels a day under their actual quotas? So I think if you reallocate those countries that are underproducing and they don't actually cut, you'll get probably more like 1.2 million barrels a day cut, actual cut, as opposed to the 2 million barrel a day headline that they're talking about right now.
That's still sizable, though, right? I mean, we've been hearing about how tight the conditions are on the world market for oil, given sanctions on Russia, given the fact that, you know, it's the U.S. is not the wild card in terms of production the way it once was a couple of years ago. Does that still create tight conditions? Does that still put upward pressure on energy prices?
I think it will. And remember, OPEC actually wants to put upward pressure on prices because they are not happy with the levels that they see. And there's two main things that I think worry OPEC. First is inflation. We've seen, obviously, headline inflation crossing 10% in Europe. We've seen headline inflation almost 10% in the U.S. Rest of the world also seeing very, very high inflation. So I think OPEC is worried about that and preserving the value of oil in the context of just price increases across the board around the world. And I think the other issue that worries them is that thermal coal prices, which is supposed to be at the bottom of the pecking order in terms of energy supplies, is trading at a 50% premium, 30% premium, depending on the market, to what OPEC believes is black gold. That is the oil barrels they sell into the market. So I think these are the two things that really bother them is the relative cheapness of oil compared to other energy sources, and also the inflation aspect. That's why they're cutting, I believe.
That's really fascinating. We don't talk about coal a lot, on our show here, but isn't coal elevated in terms of price in part because of how high natural gas prices are right now?
That's right. I mean, coal's going, well, depends where in the world, but yes, I mean, around the world, coal prices have risen very aggressively because natural gas is skyrocketing on a global basis. In the U.S., it's actually the reverse. In the U.S., natural gas prices have been chasing Appalachian coal prices higher. And again, Appalachian coal prices are moving higher because they can be easily exported out of the U.S., and they're chasing this run-up in global markets. But remember, there's one energy commodity that Europe has actually sanctioned coming out of Russia, and has been sanctioned since August, and that is coal. That is the one of the tightest markets in the planet right now, and obviously with natural gas trading at $400 a barrel of oil equivalent, coal trading at 100 seems a bit of a bargain. And obviously oil is well below that in the case of WTI, and even lower than that in the case of residual fuels that are used in power generation. That's really a big story there.
So, Francisco, I get what you're saying in terms of OPEC's perception that oil is essentially underpriced relative to comparables. Maybe some of that, I don't know, is the strength of the dollar, so it's a dollar translation issue. But I wonder, where do you think they estimate the level of prices is for demand destruction, or for something that tips the global economy into a rougher place?
Well, look, I mean, the global economy is already in a pretty rough place. Because we are undergoing the worst energy crisis since the Iran Revolution in 1979, 1980. What's different to the Iran Revolution is that back then we actually had an oil crisis, and it was a global energy crisis driven mostly by crude. This time around is essentially an energy crisis that originates in gas and power, and like every gas and power crisis, is much more local. So Europe is really the epicenter of this crisis, with the highest gas and power prices in the world. Europe is trying to displace all those molecules that used to come from Russia, and trying to find sources of energy all around the world, screening for tons of aluminum around the world, screening for tons of steel that are no longer being produced in Europe, or even fertilizers. So really, I think the important thing to understand here, this is impacting the rest of the world a lot more than it's impacting the U.S. And I realize that obviously all the consumers around the world are suffering of high prices, but the American consumer is much better off than the consumer rest of the world. And this is, of course, partly been triggered by the drop from $5 a gallon national average of gasoline back into the $3.50–3.75 range. So I think, I mean, again, I'm not trying to justify the OPEC decision, but I do think they look at it that way, and ultimately are trying to preserve the value of the terms of trade of the currency. But it is, of course, a challenging decision because, as you pointed out, many parts of the world are really suffering under this skyrocketing energy prices, particularly gas, power, and coal.
Shepard Smith here. Thanks for watching CNBC on YouTube.